Hello, I'm Kimberley Dondo, Digital Content Manager, and welcome to the In Conversation With series, a series where I speak to notable figures in the realm of financial services. Listen as they share their personal journeys, thoughts on the industry, and advice for aspiring advisors. Hello and welcome to In Conversation With. I'm Kimberley Dondo, and today I'm joined by Mike Coop, Chief Investment Officer for Morningstar Investment. Hi, Mike, and thank you for joining us today.
Hi, Kimberley. It's an absolute pleasure to join you.
So if you could tell us a bit about how you got started in financial services.
Yeah, it's a long time ago now. So we're going back to New Zealand in 1987. And I just finished a degree in economics, and I discovered I really enjoyed economics and just trying to make sense of what was happening in the world around. So I managed to get a role reviewing fund managers, actually. And the thing that I found most interesting really was just trying to see how different people invested and what was successful, what was not successful, as well as to trying to understand what was happening around us to the economy, whether it was growth, inflation, interest rates, whatever it was, to try to make sense of it all.
Yeah. Well, with that, I was just wondering, with your wealth of knowledge and experience, so we are almost halfway through 2023, but what is your outlook for the rest of this year, and where do you see the most promising investment opportunities?
Yeah, that's a great question, Kimberley. And one of the things that you learn over time is how often you can be surprised by what ends up happening. Mm-hmm. The shocks that have happened almost every year have taken everyone by surprise. So it tends to mean that you somewhat focus on the longer term, more reliable factors or gravitational forces. In the short run for this year, there are some things that we can say about the environment for investors. The first is that actually markets offer much better value than they have for quite a while. And of course, you can get a better return on cash than you could a few years ago. And so from that point of view, being invested, it's a better time to invest money. Because you can get a better rate of return than you could a couple of years ago. So that's the first thing. I think that's going to continue to be the case, certainly with cash. The second thing is, in terms of how we see the world, we look at valuation and we look at whether things are above or below our assessment of fair value. And as we look at that, we see emerging markets offering much better prospects than developed markets. Mm-hmm. And then the third is, this is no time to be invested in speculative investments. Okay. So get rid of your speculative investments if you have any, because the sunshine and the sunny days that are needed for those speculative investments are gone, and this is a risky time to be speculating on things. Okay. That seems like a reasonable answer. And you spoke of, shocks that have happened, throughout the years. And I think a couple of the biggest ones this year was quite like 3 major banks needing bailouts and buyouts. So how has the banking crisis affected, the bond market, and what should investors be aware of with this? So banks that we've heard a lot about in the media are varying quite a lot in terms of the sort of banks that they are and what it was that got them into trouble. So one of the banks, SVB, was really specialized, very specialized in dealing with organizations that provide capital to startups, venture capital. It ran into some problems of its own making. Which somewhat came about because interest rates rose a lot, but that's not an unusual phenomenon. So it's really a case of poor management by the bank. The other big high-profile bank that people might have heard about is Credit Suisse. Yeah. You think Swiss banks, you think security, reliability. But in that case, it had a long history of managing risk poorly, quite a few scandals, and eventually it was just the end of the road for people being prepared to trust the bank, provide it with capital. Each of those two examples are relatively idiosyncratic So driven by circumstances specific to that company. What we can say is that there was a catalyst for both of these things happening. And there's one of the sayings attributed to Warren Buffett is, when the tide goes out, you see who's swimming naked. And the analogy here really is, when interest rates go up, it gets tougher for companies that have borrowed money, because then they have to, whatever they've done with that cash that they've borrowed, they've got to get a return on that money that's now higher than it was before, because they've got to pay that interest rate back. And as you see that happening, whether it's a company who's borrowed money to expand, whether it's a bank, whether it's an individual who's borrowed money to buy a house or speculate, it applies to all of them. And so the real message here isn't the banks, it's the catalyst that is exposing poor risk management, poor practices, and that's rising interest rates. We haven't had interest rates at 4% for ages. So for many companies and for many people, they're just not used to having to deal with that level of funding. So that's really the key message here. Banks per se are pretty different from the horrible risk-taking beasts that they were back in 2005, 6, and 7, when they were taking excessive risk. They were lending poorly. They had no buffers. And so many of those went bust in the financial crisis. And those that didn't go bust were either bailed out by the government and forced to be completely different animals after that, much more cautious, or the regulators required banks to completely change their behavior. So banking system today is not like it was before the financial crisis. It is not on the precipice. Of course, banks are entities that take people's money and then lend it out. And so when they do that, they take risks in lending it out. And so they are always impacted to some degree or other when you get a rough ride on the economy, but then in no way comparable to what happened in the financial crisis. So people shouldn't be thinking, oh my God, I need to pull my money out of whatever high street bank I'm using, because they're going to go bust. They're not going to go bust.
Yeah. You don't need to hide that money under your mattress anytime soon.
Exactly. That's right.
Okay. Well, so we've all been feeling the pinch, as you've said, with rising inflation. So what would you say has been the impact of inflation on the UK economy? And also, what does this mean for investors?
Well, inflation is generally bad news for everyone. We're all having to spend more, and our income isn't going up by the same amount that all the things we buy have gone up in price. So what it really affects most is those on a fixed income or on a very low income where you've barely got enough to cover your costs. That's where people are really getting impacted heavily. If people have an income level where there's still a buffer between the amount they have to spend and the amount they earn, then there is some capacity to deal with that. If they've been able to save some money and stash it away, then that also helps them get through this. The inflation story is complicated, but really is, in a nutshell, two things. Firstly, it's one factor that is fading. And that factor that is fading is the imbalance between demand and supply that we saw in the COVID crisis, when everyone couldn't work, but they were still paid money. And usually when you can't work and you can't go out the door to do things, all of your spending gets channeled into a smaller number of things, in this case, goods and maybe mucking around with the house. Yeah. Whereas most of our spending is services, but we couldn't spend because we weren't able to go out. Yeah. So suddenly you saw demand for those things increased a lot because that's where the money was going. But of course, all the factories that make things were shut. And so there wasn't a supply response. And then suddenly you have this massive price increase. Now, there's a lot more to it than that. But in essence, that's what happened. Over time, that's eased, both because factories have gotten back to producing stuff and the bottlenecks that existed in the system have eased, as well as people are now spending less money on those things because A, they can spend money on services again because they can get out of the house, but also there's just less money to spend because, as you mentioned, the cost of everything's gone up. And so there's less discretionary spending. So that part is fading, that inflationary surge is fading. The other thing that's taken its place somewhat has been the cost of energy, which we all know is pretty high. And and that has its roots really in the Putin's attempted invasion of the Ukraine, which has changed the dynamics around the energy markets around the world, and has also pushed up the price of food commodities because of the impact on Ukraine, which is a big exporter of wheat and wheat in a lot of things, and other essential food commodities like edible oils. So those things are taking longer to feed through for UK households. The impact is, of course, heating our houses, where we see it the most, because we're reliant to some degree on gas for that. And the gas price got very high on account of the sanctions and what Russia's done. So those things are still high. They're working their way through the system. Our own view is that too will ease over time. But at the moment, that definitely means that people are feeling the pinch. What does it mean for investors? Well, actually, because the central banks have been forced to raising rates, it means you now get more money on your savings.
Right.
So that is an unambiguously good thing. Being able to get 3.5%, 4% without taking a lot of risk is a good thing for investors, and it's meant that that's a viable place to have money if you need to get your hands on money in the short term and you can't afford to take the risk that you need to take to invest in things like shares and property. Of course, what it's also done is it's pushed up the cost of borrowing, as we've discussed. So what it really means is, if you think about borrowing and you say, well, I've got a certain amount of money, I could use it to spend money, and whatever I've got left over, I can either use it to invest or pay back my debt. So if I think about the maths, when I'm paying back my debt and the cost of my debt is zero, then generally most investments will give you a rate of return greater than zero. And so you can make some kind of return. The problem is that whole dynamic changes when the mortgage cost goes up, and actually all of a sudden your mortgage is costing you whatever it's costing you, 4, 5, 6%. And to find an investment that is comparable with no risk and with no cost that gives you the same return is really hard. So when you get the situations happening where your mortgage rate pops up, actually trying to pay the mortgage off can be the best thing you could do, because you can't find an investment which is risk-free and cost-free that can give you the same level of return. So that's one thing people should think about, those who've got debt, whether it's a mortgage, whether it's a loan, and even credit cards. So that becomes quite important, being able to pay that off. So really, those are the more immediate things. One other thing people can bear in mind is the fact that as interest rates have gone up in terms of what you can earn in the bank, there are these things called government bonds, where you are lending money to the government and the government pays you a certain interest. And if you want to, before they pay you back, you can effectively find someone to buy it off you. A bit like if you had a car and you're selling the car your car secondhand to someone else, except that this is just you've given your money to the government and they've committed to pay you back interest and pay the money back. And so you can sell that promise the government's made you to somebody else if you want to before the term. So those things, in those types of investments, government bonds, you can get a higher return than you could a couple of years ago, because they follow somewhat the path of interest rates. So now, say for investments, you can get a better return than you could previously. And so for people who've got really short-term savings horizons, that's not a bad thing. So, government bonds, are something that people should consider, as well as cash, and give you a better return. Paying back debt where you can with these higher rates, also a good thing to think about.
Okay, that's a lot of good points. But I don't know if you have been thinking about this or listening to any of the news around, the evolution of technology right now, with AI seeming to be accessible to pretty much everyone, like even in my team, we're using some AI, just playing around with it mostly, and it's been fun. But I wonder, what role do you see technology playing in the investment landscape over the next few years?
And you're right. It's very exciting to have. It's fun too. There's fun stuff you can do with it, which is pretty cool. Well, technology. To put this in some kind of context, technology has always been advancing at a certain rate, and enabling things to be done that previously took longer or were more costly or couldn't even be done because no one worked out how to do it. So if you look back over a long history, whether it's locomotives, creating a whole new way of transport, whether it's the creation of electricity, whether it's the computer, you've had many innovations that have sped up the ability to do things, and that seems to be where we are today. It's picking up again in terms of the rate of change and the extra things that can be done that couldn't be done before. What does that mean? Well, there's a couple of things to think about. Firstly, when we look at investing and we look at companies that are at the forefront of this, as with any company, it's not just what it can do and the potential growth. It's whether the other investors have formed a very positive or negative opinion about that. And when people form a very positive opinion and price in fantastic possibilities, that's when you get a disconnect. And the disconnect is, yes, this technology may be able to deliver marvelous things, but I'm paying a very high price as an investor to own shares in the companies that do this. And if things don't quite go right because the company doesn't execute on its plan, or there's some other technology that emerges that isn't known today which can compete with this, it can mean that those rosy expectations that are in the price don't get met. And so it ends up being a disappointing investment. To give you some analogies, back in 1999, when we had the last period of great euphoria around technology, we had great advances of things that you could do on your mobile phone, which came to pass not many years later. But all of the companies swept up on that got priced at such high levels that many of them fell 70%. And then the ensuing years, the better ones recovered and, of course, went on to great things. But even things like Apple or Cisco or Microsoft, companies which, are large established firms, had that same experience. So the price you pay to own these things is very important. And what we've seen is an over-enthusiasm for technology going back over the last 12 to 18 months, and innovation in general, which ended up making them poor investments, even though the technology was able to fulfill its function and was able to eventually come good. So I think that's one thing to think about. The second is the second round impacts of technology. Great technological advances do one thing. They bring down the cost of producing things. So they're actually quite deflationary.
Right.
They allow us to produce more with what we've already got, or indeed be able to lower the cost. And so eventually what happens is prices come down. So that's good for everyone because it means that your money goes further, and the companies who profit from that aren't just the ones making the technology investment, the ones who can work out how best to apply it. So it's certainly exciting. It should ease longer term some of the inflationary pressures, including, in some industries, it's going to be a game changer in terms of the things that can be done with much lower cost. Fewer people will need to be involved for those. On the other hand, there'll be new industries where people will have jobs created. As I think about, my 13-year-old, my 11-year-old, they're going to graduate from university. That's what they do, with whole new industries and jobs that I can't even begin to imagine. So very exciting. It'll be positive for growth, positive for inflation. But as an investment, you've got to be pretty careful about the price you pay to own these types of things.
Right. Yeah. I was thinking about that, like the dot-com bubble. I wasn't very cognizant of it when it happened, but I've heard a lot about it, how excited people were, and then it just burst. And I can imagine, there's so many different, companies coming out and saying that this is what they can do, and people will get excited at this new piece of tech that's coming out, but it depends on whether they deliver. And that is quite important. And you have talked about what I would class as diversification quite a bit throughout our conversation so far. So I can imagine that you think that diversification is quite important for investors. But what strategies would you say are the best in order for investors to achieve that?
Yeah, so I'll use a kind of a different analogy here. So diversification, you could identify investments that you think will give the best return. And we've got a very detailed global process that we go through to assess fair value, see what the price today is, and then find things where the price is well below the fair value, and we should be able to get extra return than we normally get. And we want to get as much return as possible, but we know that the more we push in that direction, that we could end up only having a small number of investments, and maybe they're driven by the same factors, so that they'll all do well or all do badly together. And that means there are going to be certain environments where we could end up not getting a very good outcome. In fact, we might get an outcome which is unacceptable to us. So this is where diversification comes in. And it's really about making sure that you've got outcomes that you can live with, and you don't really know what's going to happen in the future. The world is very complex, as we found out with all the supply chains that unraveled.
Yeah.
And then secondly, there's a randomness as well about the things that can happen, which can't be forecast. Decisions that get made, whether they're political, whether it's climate related, whether there are knock-on effects, it really isn't possible to forecast these things with any degree of confidence or accuracy.
Yeah.
And so what exactly. And diversification is really about recognizing and having humility and going, look, I don't really know exactly what's going to happen. I can conceive of a variety of scenarios, and I need to be able to know that I can survive those and have decent outcomes for myself. So in some respects, it's like a form of insurance. Now with insurance, if you try to insure your car, for example, or you've got any other form of insurance, there's usually some payment you have to make. So there's a cost. And the big question you've got to ask yourself is, well, is the cost too high? And so I'll spend all this money on insurance and it just won't be worth it. Because you're insuring against the likelihood of something happening, and that something happening maybe not really that likely. Maybe there's a 10% chance or 15% chance something will happen. But if it happens, there could be a severe outcome, and I need to know that I can survive that. So I've got two choices: either find things which are forms of insurance where the cost isn't too high and it's still worth my while doing it, or if there is no insurance that I can see, I need to own less of the thing that I've got, which has given me exposure to this risk. So there's two ways to look at it. Bringing it back to simple terms, shares are generally the investment which will give you the growth that you need. And for those who are investing long term and looking to save enough money to maybe buy a house or their retirement, or longer term goals, maybe fund education needs, shares are the go-to asset. They generally will give you the highest return, but you need to have a spread of shares in terms of different types of companies, different types of industries, different types of countries around the world, so that you're not overly exposed to bad things happening in one company, one industry, one country. So having diversification at that level is important. And for example, in periods where economies fall, economic growth is weak, in a crisis, certain industries tend to hold up better because those industries, the demand for what they're producing is always going to be there. They're essential items. Healthcare is one of those. Utilities is another. And so in a recession, they're going to hold up better than other industries where, when you find that you've lost your job or your income isn't growing, you're going to cut back on spending money on those other items, whether it's going out or certain sorts of goods that you'd otherwise buy. So having some exposure to those, safer, essential industries is one way to provide diversification in equity portfolios. Then, of course, you want some other assets which will hold up in the environment that's particularly bad for equities. So the kryptonite, if you like, for equities is a deep recession. That's when companies have a real risk of going bust. So you want an asset that can do well in that environment, and government bonds are usually that asset. Government bonds issued by reputable governments are a better investment. So some mixture of equities and bonds is a safe way to diversify, as well as having some diversity within your equity portfolio.
Okay, that makes sense to me. And I think that's something I'll probably be looking into myself. But I know that you're by no means like a fortune teller or anything like that. Although I think your years of experience might help with, my final question, which is, what is your long-term outlook for the UK economy, and what would you think the potential impact might be for investors?
Yeah, so the UK is a really interesting economy stock market because of its heritage. So it's got a heritage of being global.
Yes.
It's got companies that operate all around the world. It's got a really good legal system that makes it a reliable place. If someone signs a contract and commits to doing things, then usually they will follow through on that, and the laws are reliable. So it's a good place to do business. And it also has a heritage in things like applying technology and commercializing things. So it's got many great things which, along with an educated population, make it, inherently a country and a society that can bounce back and adapt. So that is something we shouldn't lose sight of. It's been through a tough period for two reasons. One, it took a big hit after the financial crisis because it had an oversized financial sector, which took too much risk. And the adjustment from that hit the growth in the economy, it hit the tax coffers of the government, and that's resulted in slower growth than otherwise would have happened. The second is the effect of the Brexit in terms of the adjustment that's had to happen with our biggest trading partner, which is the EU. So those two effects have slowed growth down. And based on what's been happening more of late, it seems that there is now going through a different phase where we're coming through both of those things as the economy is starting to adjust to Brexit. We've had an improvement in the relationship with Europe that's fairly recent, and in fact, President Biden's visit to Northern Ireland is somewhat a reflection of that. And we've had also, I think, a broader range of industries that the health sciences have been a fantastic success. So there's many great things about the UK that will mean that it will ultimately adapt well. But it's been through that period of adjustment where it will need to continue to adapt itself to that. And what will happen there will depend upon the government that gets elected and the policies that it puts in place. And so when you're looking 5 or 10 years out, it's rather hard to be categoric about that. So I think the UK does have those advantages. It's probably going to have a better outcome than it has had in the last sort of 10, 15 years. But that somewhat depends upon the policies the government's put in place. The other element, of course, is that the UK is not an island. Well, it is an island in one sense, but what happens to it is not determined solely by its own actions. Ultimately, we're in a world where the actions of the three major trading blocs, the US, China, and the European Union, will have a very big impact on the UK, notwithstanding the fact that it can also trade with other countries and other regions that are important, like India. So I think really, the classic economic maths around growth is the number of people you've got working and how many hours they work, as well as how productive they are. And so the size of the workforce depends on demographics. It depends upon fertility rates. It depends upon immigration. And it depends on the health of the population in terms of their ability to work. Now, historically, that's increased as life expectancies increased. Weirdly, we've had a situation where life expectancies actually come off a bit. And that's partly, or hasn't grown to the extent that people were expecting, and that's partly because of we've had tremendous benefit from medical advances in terms of being able to deal with the sort of ailments that kill people at a fairly young age and cripple them. And so you've had tremendous gains, and it's been difficult to continue to support that same degree of effect as if you kind of picked a low-hanging fruit, if you like. Mm-hmm. So that then, fertility rates have also come off, and fertility rates are kind of aligned to boom and bust. When people feel confident about the future and prosperity, they're more likely to want to have families. And so we haven't had a period like that. And then on the immigration, it's kind of waxed and waned, but actually still relatively high. So those things suggest that it's really going to be productivity, doing things more effectively. What you mentioned earlier, Kimberley, with innovation and technology is really important, the ability to apply those things. And so, again, the UK has a track record of doing those things. So I think those things are all positive. What does it mean for investors? Well, the UK stock market is really pretty global. Most of the earnings of companies are sourced outside the UK. So a lot less than you might think. It's only some of the smaller companies where it's a bit more oriented. So I think globally will really dictate those things. The real estate markets, commercial real estate, is somewhat the same because it's companies who are using land to do things and buildings on them to do things, and many of those are global companies. Housing may be more of an impact there because that's a bit more localized, but even there, the shortage of new housing compared to demand means there hasn't really been anything of a game changer there on the supply side.
Right.
And so you still have the sort of supply demand imbalance, which is more focused on the areas where jobs are being created, which is really, typified by London. So I think there's nothing particularly I could say that would add to those things in the long run. The bottom line really is UK's been through a tough period. It feels like it's coming out of that. There are some positives longer term and potential it has. The stock market is less really driven by those things. And so for most people, it won't really directly impact them. It might, impact them more through other types of investments like housing, which at the moment is sort of coming off a peak where house prices went up a lot in response to the cheap money and the moves that happened around COVID. And so we're seeing some comeback of that as mortgage rates go up and affordability comes down. But in the long run, the housing demand supply and balance hasn't really changed. And so, it'd be hard to really see things being fundamentally different. Maybe house prices grow at a slower rate or stagnate for a while, but that dynamic still seems to be in play.
Okay. Well, that seems like quite a positive outlook, and something that I like to hear personally. But it was really great speaking with you today, Mike. Thank you so much for talking to me.
Kimberley, it's an absolute pleasure. And I think it helps people so much to have podcasts like yours, just trying to break things down and provide information. So hopefully today's been also helpful for that. But good luck to everyone who's listening, who's a saver and an investor.
Thank you so much.
My pleasure.
Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine. So make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.